What is the BRRRR method? So the idea with the BRRRR method is to buy a property. Let's just put BRRRR. So you buy a property, you rehab a property, you rent a property, same property, and you refinance. Okay, so the idea here is you're trying to get into a rental property with as little money as possible. To do that, you're going to buy something using hard money. You're going to fix the property up. You're going to put a tenant in there with your hard money lender's approval. That's a big one. And then you're going to work on a refinance. But before you do the refinance, you're going to get pre-approved before you actually make the purchase so that you have a really good idea that the refinance is actually going to happen. Now, to do the BRRRR method, you are going to have to qualify for financing. Now, you can do what's called a DSCR loan, which is a debt service coverage ratio, which means a lot of the requirements that you may have are not as stringent, but there is still credit qualifications. Meaning, if you're in the middle of a bankruptcy or in the middle of a foreclosure or collections or judgments or those things, you're not going to be able to get this DSCR loan. Otherwise, this DSCR loan is basically saying debt service ratio. So what they want to make sure is it's a 1 to 1.5%, which basically means that if your payment on the loan is $1,000, they want to make sure your rent is somewhere between $1,000 and $1,500. Okay, depending. So some DSR lenders will say we're 1.3, some will say we're 1, some will say we're 1.4. What that basically means is for every $1,000 in payment, they want $1,400 in rental income. That's what that percentage basically means of that DSCR. Now, if they're at 1,000, and they're at 1% DSCR, then that means the income from the rent needs to be 1,000. Does that make sense? So it's that percentage that they need on the rent versus what the payment will be on that DSCR loan. And you may be wondering, okay, what's my payment going to be on a DSCR loan? And that's why you'll come here to just this amortization calculator. You'll put in here how much the loan amount will be for, and you'll come in here and put an interest rate in. It's typically going to be a little bit higher than the interest rate that's on the streets, probably between a point, a half a point to a point, because you are going through the DSCR. We need to put this as a 30-year loan. Perfect. Calculate that up. Monthly payment, $2,212. So if this was a DSCR loan, when I'm taking out the financing, and they were at a 1% ratio, that means I would need my income from the rental property to be more than $2,112. Okay, I would need that or more. If they were at 1.2, I would need it to be 20% higher than that, so roughly $400, so $2,612 approximately is what I would need, and my payment would be $2,212. So let's talk about why the BRRRR method is so important and why people like it. There's a few reasons for this. Okay, let's talk about why the BRRRR method is important. So if you buy a house and you fix and flip it, let's say you buy it for 100, you put 50,000 into it, you've got 25,000 of additional costs, so it's $175,000. And let's say you sell it for $200,000, and let's say all your costs are included there, so you have a profit of $25,000. Okay, you are going to be taxed ordinary income in most cases. Talk to your CPA and those things, but you're going to get basically ordinary income tax on the profit that you made from that transaction. Let's do this as a BRRRR method. Okay, so as a BRRRR methodology, what I'm going to do is I'm not going to take any profit or make any money. I'm simply going to refinance this at the 175. I'm going to refinance that property, not take any cash out, take my short-term hard money loan to a long-term 30-year loan, and refinance it. So typically when I'm doing that, the lender's going to want to be somewhere around 80%, might be 75, maybe a little higher than 80%, but 80% loan to value, which basically means if I need 175,000, that means that it's 75 or 80%, 175 divided by 0.8, that means I would have to have a value at $218,000 of the appraisal, okay? Now, a couple of things here. What if my appraisal didn't come for $218,000? Well, then you'd be $18,000 shy of what you would need, and it would require some cash to close. Now, you may have already put money into the deal, or maybe you sold it for 200 because you negotiated, but the appraisal value will come in for higher and you could do the refinance. Ideally, what happens here is you buy a house with little to no money down. Okay, so this is the ideal situation. And with this, I want to make sure we realize we're not paying tax because we're not getting the income from that. We're actually saying, I want the monthly and I'm going to hang on to that. Now, one of the cool things about this strategy is, let's say rates are, I don't know, 6.5, 7.5, whatever the case is. If you get a 30-year fixed loan, that payment's not going to change for the principal, and interest payment is not going to change. The taxes and insurance could, but the principal and interest is not going to change. However, if interest rates start heading down and interest rates drop to 4% or 5%, you can refinance at that lower interest rate and start paying the lower payment, and you can do what's called a rate and term refinance. You're not taking cash out or anything, you're just refinancing and getting a lower interest rate, which is a great opportunity of tying up properties in this market when the rates may be a little bit higher, with the plan to refinance them at some point if and when the rates get lower. Okay, so let's talk about this. Okay, so let's say this would have to be a really, really good deal, because if you're going to do 100% financing and not come up with any money, it's not just going to be your average deal. So your average deal, you may have to come up with some money with. That's just how it works. You're a really good deal, so you wouldn't have to. But let's just say you bought this property and you bought it for $100,000. Okay. And let's say that you put $25,000 of rehab, which I know is pretty low. You're probably closer to 50, but let's just use simple numbers here. And then let's say you had $25,000 of interest and title fees and all that type of stuff. And then you've got to resell. Let's say you're another $15,000 to resell. So let's just say, where does this put us? 165, okay? 165,000. Now, if that property values, let's say 165 divided by 0.75, if the ARV value on that is $220,000, okay, which would be 75%. Sometimes we can go a little higher, but let's go 80. 165 divided by 0.80, so 206. So if that value comes in somewhere between 206 and 220, you're going to be able to get 100% financing as long as the purchase, the rehab, the closing costs, the title, and 5 months worth of interest in most cases, depending upon the market. If all of that is less than 75 to 80% of the after repaired value, then you can get a hard money loan that will finance 100% of that. Will finance all that. Okay, that's the ideal scenario, right? And then you fix this property up. Now, instead of reselling it, I'm going to keep it, which means I'm only into it $150,000 because I've got the rehab, I've got the title, and so I'm not paying any of the resale costs, so I'm $150,000. So then what I do is I go and I refinance this to a long-term lender. I get a 30-year loan. I pay off the hard money lender with their interest and everything else like that. And I end up being into a property with little to no money down if I structure it properly. So the whole concept with this BRRRR methodology is to get a property where you're putting little to no money down. And the way that you do that is by negotiating a good deal and by adding value by making the property worth more based upon the repairs that you're doing to the property. Now, with that negotiating and with the value adding, if I can get that at 80% or less with all of my costs, then I can do a rate and term refinance, pay off the short-term hard money lender that's gonna have a loan for 5 or 6 months, and get into a long-term 30-year fixed mortgage, which could be the DSCR or something else. And then I've got that fixed interest rate for 30 years or as long as I want that to work out for. And then I have the ability to refinance. So the BRRRR methodology is to help you acquire rental properties and to help you not have immediate taxes since you're not claiming that or bringing that in as income. and helping you grow your real estate portfolio with as little money as possible. And that's really what it comes down to, is how can I acquire good properties without a lot of money out of pocket? And that's the whole concept between the BRRRR methodology.